The market is down 20% thanks to the global trade wars. And are we entering another 2008 global financial crisis? I get this question all the time from Zoomers and young millennials. And look, I had a front row seat to this collapse. I was a 20-year-old investment analyst at BlackRock's fund of hedge fund group, covering some of the world's largest multi-strategy hedge funds. In this video, I'll break down the root of the subprime crisis, how it created this interconnected web of very risky and complex assets, what happens when correlations go to one, and how bank runs took down the entire system, hitting the Wall Street crowd and the Main Street crowd. With that, you will have the best context to navigate the current volatility. So let's jump in. Let's set the stage first and look at the situations that were leading up to it before. So let's talk around 2005, 2006, 2007. The main thing that was happening is we were coming off of the dot-com collapse. The Fed had lowered interest rates to a pretty low level to keep the economy humming along. And so what happens when you have low interest rates for a long period of time? People start taking risk. And one of the places that I really want to get you to the genesis of the problems in 2008 was the subprime lending market. So these were loans to subprime borrowers. So they were lower quality borrowers, and they were being made left and right. I mean, some of the excesses here, these were credit scores under 600. These were homes that were in the $200,000 to $300,000 range. There was 100%. They were like no doc loans. Like you didn't need to submit any documentation on your income. There was 100% loans, 105% loans, because there's closing costs, right? So you could even finance the closing costs. So you could walk in, buy a home, not even like pay a penny, and then walk out with a home, right? So people were buying these homes, people who shouldn't have been buying homes, and speculators were buying home. I pulled up an example. Also the loan terms were really flexible. So they were interest only loans, and then they were what were called hybrid ARMs, but I don't need to bore you with the details. But let's think of this as the raw material, right? They were these loans. They were dodgy loans. We didn't know it at the time, and they were being made in mass across the country, right? So that's the raw material. But here's the interesting thing that happened is that there was securitization. And what is securitization? Let's do a little theory download. Securitization is basically when you take a bunch of raw materials, and in this case, it was these subprime loans, but it can be done for anything. And you get a lot of, because no investor wants to buy a $200,000 mortgage to one borrower, right? It's too much work. It's too small. There's idiosyncratic risk. There's no diversification. So what banks, and they're also basically, they were called subprime originators, what they would do is they would gather around all these loans and they'd make a giant, what's called an RMBS, a securitized product, a residential backed mortgage security, RMBS. And so you might take like $500 million worth of these loans, package them together. That would be step one. Then step two is you would chop it up. You could think of it as a waterfall, right? So you have these loans. Think about, let's say 20% of the loans default because they're subprime. You are expecting losses. So that would mean that 80% of the loans don't. So in a very simple example, you could chop up the loans as 80%, like the top 80%, and the lower 80%. And the top 80% would be deemed safe. So it'd have a lower interest rate. And the bottom 20% would be very risky because you could lose a lot of that principal. So you might have like a much, much higher interest rate as an investor to reward you for that risk. Now, that's an overly simplified explanation because they would chop it up at many, many different levels. And each level would have a different amount of risk, and each level would have a different amount of interest payment or coupon or yield, depending on how you want to describe that. So then you had this these repackaged goods and different. Now, the theory on this is that all of these investors have different risk appetites. So some people want to buy really risky stuff and some people want to buy less risky stuff. And so if you can take this raw material and cut it up into risky stuff and less risky stuff, then you basically open up your market of potential buyers. And so that was the appeal of securitization, was that you could take something that inherently wasn't that good, these subprime loans. Like, people knew that they weren't that good. They didn't know how terrible they were, but they knew that they were bad loans, and you could package them up. And because of that, in that example, that top 80%, you would be in a good position. You have a good asset, right? That could then mimic something that was high quality, maybe not like a US Treasury bond, but a very high quality bond, like a bond from Microsoft or some giant firm with a lot of cash. So securitization was built on this theory of risk transfer. And a lot of people were drinking the Kool-Aid where you could say, like, there's a market, you open up the market, and securitization has been around before, but started to happen across the board for all different types of assets. And this kind of originated the credit crisis, where they were doing it for loans that were for private equity companies. They were doing it for real estate transactions. They were even doing CDOs of CDOs. So they were taking these repackaged goods and repackaging them again. And this is where, in hindsight, my cynicism of Wall Street was like, this is kind of messed up, where you were basically just making things for the sake of making them, and then remaking them, and then remaking them. And guess what? At every layer, there's more fees for the people that makes them. And at every layer, there's more complexity for the entire system. And as we'll see in 2008, that complexity completely got out of hand. Okay, so that's the raw material. This is happening in the 2006-07 era leading up to the financial crisis. Another thing that happened was that, again, when there's low interest rate environments, and we can compare that to the low interest rate environment we just left here in 2025, you start to see a lot of speculation, right? So in this recent, in 2023, low rate interest rate environment, you saw all the crypto speculation. You saw FTX go bankrupt. You saw First Republic Bank. You see the excesses. People start doing riskier stuff when there's low interest rates. So we'll come back to that. But in the 2006-07 period, there was low interest rates, and people were just trying really hard to make money. And there wasn't like a ton of way to make money. So let's zoom into what did hedge fund land look like. In the pre-crisis era, hedge funds looked very different than they did today. Today, in 2025, a lot of hedge funds is dominated by what are called the multi-managers or pod shops, like Citadel, Millennium, Point72, Balyasny, Jane Capital, I'm sure, Schoenfield Asset Management. And so these are the major hedge funds that exist today. Before the financial crisis, it was much more what was called traditional multi-strategy. And traditional multi-strategy was one cohesive team. Usually there was a CIO, and there were firms like Citadel and HBK and Davidson Kempner and Ox Ziff. Those were the big, Aristea Capital. These were like the big names, King Street Capital from before the financial crisis. And they had a different model where the pods today all operate independently, and they have really tight risk limits, and they don't interact with anyone else. I think Citadel has like 150 pods. A multi-strategy fund, you might have one credit team, one risk arb team, one mortgage team, one quant team, and they would roll up to one CIO and a risk management function. But they were kind of like giant diversified investment firms where there was interaction between the different teams and the CIO could move things around. So these multi-strategy funds, a lot of them originated in two strategies. If you take like someone like Citadel, they originated in convertible bond arbitrage, where I won't get into the details here, but it's an arbitrage strategy. Then they added like long short equity, fundamental long short equity. Some of them added credit. Then there was risk arbitrage, which merger arbitrage, which is when you bet on mergers happening. And then they would add different like quantitative trading strategies, different like fixed income arbitrage strategies like long-term capital. But basically they were like a diversified pool of strategies in these multi-strategy hedge fund. Now, remember though, everything was, because interest rates were so low, everything was very expensive, right? So it was hard to get extra yield from credit instruments. That's why you had to do all this repackaging stuff. Merger arbitrage spreads, which is kind of the arbitrage you try to capture in a merger, were very tight. So there wasn't a lot of juice in them. So you had to use leverage to juice up your returns. If you were buying mortgage securities, you had to take more credit risk, like the loss of default. High yield spreads were really tight. Loan spreads, interest payments were really low. Again, because there was so much money in the system, it was hard to get additional return. So what do people, and particularly hedge funds, do when you need to get more additional return and your raw material isn't giving you that? You use leverage. And the way you use leverage is not dissimilar the way that I use a little bit of leverage in my portfolio. Is you call your broker and you say, hey, I want to borrow some money from you. The money is collateralized by the things that you own, and then you just buy more of the things that you own. And so as an example, me personally, I borrow 10% of my portfolio. So I have 110% exposure to, for me, it's stocks relative to how much stocks I have, how much capital I have, which is 100. So that means all of my gains are amplified by 1.1x minus the interest payment that you have to make. And all of my losses are exacerbated by 1.1x. And so that's how leverage works. It cuts both ways. And we're going to come back to the leverage challenge. So next up, there are signs of stress. And again, we're in 2007. Here we're in April 2007. And you start to see signs of cracking in the subprime market. There were two major events there, Countrywide and New Century. There were a lot of these like subprime lenders where basically they would go and make these loans. And what they would do is they would hold these loans on what's called a warehouse line, which is basically a bank lending, giving you a credit, right? It's similar to margin, but they can revoke it at any point in time. And what these companies were doing is they were originating, creating all of these subprime loans, and then they were borrowing money because they didn't actually have much capital, like these originators. So they were what's called very thinly or poorly capitalized. So they would put up a little bit of capital. And I think the leverage on these was 10x. I think there might have been 20x on some of these warehouse lines, because the thinking was you originate these loans, you put them on the warehouse line, basically like a temporary storage facility, and then you would sell them off to securitization, and then you would rinse and repeat. And that was part of the challenge with this business model, is that the subprime originators were getting compensated by transaction. So they were very incentivized to just do a lot of transactions, and we'll come back to the incentives later. So in 2007, early 2007, what I believe started to happen was that you started to see some signs of losses in these subprime portfolios. And how would losses occur? People were not making their mortgage payments, or they were walking on their homes. They got laid off, or they couldn't afford to keep up. And remember the incentives. If you put 0% down on a home, the only penalty for walking away is that it dings your credit score. you don't lose any cash. So there's a real adverse negative selection here, adverse selection problem. So these were pretty, I mean, Countrywide was a big originator, but they started to have these cracks, and the banks were like, whoa, this isn't what we signed for. You don't get this credit line anymore. And once they lose the credit line, they're out of business because they don't have enough money to pay back. They suffer a margin call. So you started to see that in early of 2007. Then the first real sign of the crash, and I remember this really well, was the Bear Stearns hedge funds unraveling. Now, this wasn't Bear Stearns, the company. That would come later. These were the hedge funds. And there's a specific hedge fund there, which was called Bear Stearns. I think it was like Bear Stearns High Grade Structured Fund or something like that. And what was this fund? This fund would take, remember I said that 80% is super safe? They would buy that 80%, and it might have an interest payment of, I don't know, like 1.5%, because it was so safe. And it was rated effectively AAA. So it was like the best rating. And we'll talk about the rating agencies later. So the Bear Stearns mortgage funds would buy these AAA, very highly rated things, and they would lever them. I think, I looked this up, I think it was over 25 times. That's why. So that means for every $100 that you have, like if your fund has $100, you have $2,500 worth of investment exposure. And why were they doing this? Because in theory, because these were highly rated bonds, that top 80%, they would never take losses. And so they were just they wouldn't be volatile, and you wouldn't lose money through defaults. And so they took these and they leveraged them to the hilt. Because remember, a hedge fund's trying to make, in those days, they're trying to make over 10%. So if you have an asset that's paying 1.5%, you need a lot of freaking leverage to make that thing make any economic sense. And then obviously they have that 2 and 20 fees. So similarly, as you started to see signs of stress in the originators and the borrowers, the people that were lending this hedge fund money, which are called the prime brokers, lend money to hedge funds. They started to say, whoa, we're starting to see some losses in the system. You can't have this. You can't borrow this much. So you have to take down your leverage. But what happens is when you have to take down your leverage, you have to sell some of the assets. And when you sell some of the assets, especially when they're going down, you get a kind of run on your own portfolio, right? You get margined out. And so they had insane amounts of leverage, and eventually they went under. I don't remember if investors lost 100% of their money, but if I had to guess, it was probably they lost like 70% of their money. And remember, this was deemed a very safe investment. And again, you're going to see this is that these investments that were deemed very safe were like the furthest thing from very safe. When this happened, you started, so this is summer. I remember this well because that summer of 2007 was quite stressful because you were just seeing these little ripples, right? And in this case, the Bear Stearns hedge fund was just not a ton of people were invested in it. Everyone thought it was just kind of this one-off event. But what happened, you started to see the interconnectedness of the system. So when the Bear Stearns hedge funds lost money, went out of business, well, a lot of other people had that similar strategy on. They own similar assets. They might not have had as much leverage, but their hedge funds started to lose money. And either they panicked and they're like, we're out, or they had to sell to meet margin calls. And so what started to happen is that you had this ripple effect, and where someone had an asset that lost money. And how do you deal with that? You have to cover your margin call. You either sell the asset that's losing money, or you sell a different asset. And guess what? All these multi-strategies own the same buckets of assets. So here's a perfect example. As these funds were losing money on their mortgage portfolio, they're like, shoot, we need to sell stuff to basically fund our margin. And so what did they have? They had these quantitative trading books, these very liquid. You could think of this as pairs trading, where, you're long Microsoft, short Amazon. these really kind of tightly knit paired trades. It's much more complex than that, but you could think of this like a very diversified long short book that's all automated. And again, because these books are trying to capture just a little bit of return, you have to use leverage on them. And so what people were doing is they were liquidating their quant books because they were very, very liquid. But then the people that were holding the same quant names were losing money. And so in summer of 07, you had another quant meltdown. So think about this. You just have cracks in the mortgage market, and you had quantitative hedge funds that are doing pairs trading on random equities go out of business. That's the interconnectedness of the system. And at this point, it's still kind of really related to the hedge fund industry. I mean, the banks do some of this trading, but you saw it also with risk arbitrage, merger arbitrage spreads. At any given point in time, there's only 5 or 7 deals that people can be trading. There's not that many mergers happening. And so these funds would need to raise cash, and they'd be like, well, this merger arbitrage book is quite liquid because it's publicly traded stocks. So let's sell that to raise some cash. Well, the person that's still holding that spread, it widens out and they start losing money, plus they're levered. So you started to see these spikes in volatility and these like really weird deleveraging, this like corner of the quant market where it's just these like MIT nerds that have nothing to do with subprime lending, yet they're like going out of business. So this is in 2007. This is still a year before. I want to pause here and talk a little bit more. I've talked about securitization, but I want to talk about specifically the role of the ratings agencies. And so when you think about these we talked about securitization, we talked about risk transfer, and this is probably one of the biggest problems in this whole system was that there was these rating agencies. They're not independent in the sense that they're publicly traded companies, but this is like Fitch and S&P, but they don't trade stocks. So they're kind of viewed as more objective. And so what they would do is they would look at these mortgage bonds and they would say like, okay, historically, we've never seen more than 5% losses. Let's multiply that number by 3 just to be conservative and say that there's 15% losses. Everything else above that is safe. And so they were opining on these different parts of what's called the capital structure, and they were creating these ratings. And so the beauty of this game from a Wall Street perspective is that there's not a lot of AAA assets, which are the highest rated assets, which you basically never expect to lose money on. And the reason why the rating agencies loved subprime, why everyone loves subprime, is because you could create a lot more AAA assets by doing this securitization. And then they would stamp of approval and be like, you will never lose money on this, right? I think that the probability of losing money on a AAA bond, I think, is under 1% or maybe under 10. Let's say it's under 1%. I think it might be less. So it was just a gold mine. And by the way, there are a lot of who buys AAA assets? Banks, money market funds, mutual funds, corporate treasuries, right? It's a cash substitute. So I want you to pay attention to this. They were taking this kind of janky asset, a subprime loan, and turning it into a cash substitute where you like get a little bit more than the rate you would get at your bank. Okay, so this is 2007. You're starting to see these unwinds. You're starting to see these firms start to go down out of business, these hedge funds. So this basically continues throughout 2008, and the ripple effects start to get much, much larger. So remember how I said that a little hedge fund like Bear Stearns hedge fund could have a tiny bit of capital and own a lot of assets. And the subprime originators could have a tiny bit of capital and a lot of assets. And that works fine when your assets don't lose money and the counterparty is willing to lend you more money. But when your assets start to lose money and the counterparty says, whoa, no more, you've drank too much, it starts to ripple down. Now, guess what happened? Other bigger companies were doing the same thing. And specifically, Bear Stearns, Merrill Lynch, and Lehman Brothers. Now, if you think about, they're called broker dealers, and they were a little bit different than JP Morgan Chase and Bank of America, because those banks, while they still have investment banks and they do trading and they issue securities and so on, though the latter bank, JP Morgan and Bank of America, they have deposits, right? So people like me and you will give money to JP Morgan as a deposit, and they use that to basically secure some of their lending, right? The whole business model of a bank is that you take money, you have some money, whether it's bank deposits or equity, and then you basically borrow money against that, and hopefully you can kind of cover the difference, right? Again, that's a very simplified model on banks, but that's called NIMs, effectively net income margin. But we don't need to talk about that there. All you need to know is that there were certain weaker hands because their business model, right? There was no Lehman Brothers bank. You couldn't go deposit money there. So they were riskier. And so they would get cash from issuing equity and issuing debt in the market. Well, guess what? They were doing the same thing. They had a little bit of equity and they had a lot of assets. Why did they have these assets? They had these assets because they were holding them as inventory, right? Remember, these banks facilitate trading. So if I'm a sovereign wealth fund in China and I need to sell a bunch of bonds, US treasuries, I sell them to Lehman Brothers, and they might hold them for a couple of minutes, a couple of days, a couple of weeks sometime before they sell them to someone else. Remember, these are huge transactions. It's not like a E-Trade account where it's just a bunch of little ants that are fighting for 10 shares of Microsoft. So these are huge transactions. And so Lehman Brothers, these investment banks, and these banks needed leverage to hold these positions. The other thing that they needed to do to hold these positions, the other reason why they did it is because they were acting like hedge funds too. And this is what's called proprietary trading, where they were acting like hedge funds, but they could have been more risky or reckless, depending on how you want to define it, because they didn't have, yes, they had to account to shareholders and quarterly earnings calls and so on, and earnings forecasts, but they didn't have to report to investors who are every traditional like fund investors who every month are like, okay, how did you do this month? How did you do last month? What is your strategy? And so because they were companies, right? They weren't funds, right? You think of like your actively managed mutual fund is very different than the way you think of the Goldman Sachs stock. And so all of the banks were doing this to different levels. But two things were happening. Some were doing it more risky. Lehman Brothers and Bear Stearns were doing it more risky. They were probably buying more risky things, using more leverage, but also they had worse capitalization because they didn't have the deposits. And so basically you started to have these fears started to compound. Now we need to talk about another point, which is CDS, which are credit default swaps. And this was another creation from that era of low interest rates, from the Wall Street sausage making machine, where it's very hard to short bonds, corporate bonds. And I won't explain to you why, because it gets a little technical. It's very easy to short stocks. It's very easy to short indices like futures indices and commodities and so on. It's very hard to short bonds. Mostly because the way you short is you have to find the bond and then you have to borrow it and then you sell it and then you find the bond and you pay it back. And bonds are not fungible like stocks. So a company like Bank of America might have 1,000 different bonds and like one common stock. So it makes the whole borrowing and shorting thing quite hard. And so the geniuses on Wall Street, they're like, well, it would be really cool if we could short bonds as well. Let's create a synthetic market, a derivatives market, a little bit like an option, a little bit like an interest rate swap. All you need to know is that these were derivative transactions. So they didn't involve like holding and owning and buying and selling the actual bond. They were just a contract on the bond. And that's important to note for a few reasons. One is that when you have these contracts on these bonds, you can have a lot more options on a stock than the stock trades. So you can kind of create infinite amount of risk off of one fixed pool of assets, whether it's a stock, whether it's a bond. In this case, it's a bond. That was one thing. But the bigger consideration was that because these are contracts, right, you have to get into a contract with a counterparty, right? So let's say that I wanted to bet against Microsoft bonds through CDS. I would need, and I'm a fund, I would need to go to my prime broker and say, I want to bet against Microsoft bonds. And they would need to go find someone who wants to bet on Microsoft bonds. But the thing is, it's just like a paper contract between the two of us. And so you're taking counterparty risk, where if something happens and you need to Microsoft bonds and you need to be like, hey, bro, you owe me money. They need to have the money to pay you, right? That's called counterparty risk. And when you have these synthetic transactions, your counterparty risk can A, become very complex, and B, it can magnify in size relative to, it's kind of funny money. And when we talk about AIG going under, that's effectively what happened. So credit default swaps start to add this other element where people are like, if this thing goes under, are you able to pay me back? It was also a barometer that led, for the first time, it let you see if the market thought that specific institutions were not faring as well, right? Because you could look at a company's stock, but their bonds and their credit derivatives are more indicative of what was happening. And so this started basically what was happening in 2007 to this like small cottage industry of hedge funds was happening to major banks. And they were unwinding books, and the huge books of bonds, of mortgages, of credit default swaps, and they didn't have the money to cover them. And that is where you had these major institutional failures. So in that period in 2008, as these dominoes started to fall and continue to fall, the unwinds and so on, in March, you had Bear Stearns go under. In September, you had Lehman Brothers go under. And then AIG got bailed out sometime around Lehman Brothers. There were other institutions. Wachovia, for those of you who remember, got bought by, I forget who Wachovia got bought by. I think Bank of America ended up buying most of these. Oh no, JP Morgan bought Wachovia. Some of you might remember Washington Mutual. These were kind of these huge regional banks. And so these banks were just getting swallowed, these like big regional banks. The Fed was engineering some of these, the Treasury was engineering some of these. And as this is happening throughout, as the big institutions start to crumble, the equity market just tanks. Now you're probably wondering, like, why didn't people see this coming? And I think I want to point out two reasons why. The first is that a lot of these institutions, both the banks and the hedge funds, were using a risk model called VAR, which is like value at risk. And basically, value at risk is it's like a backwards looking metric, a little bit like what we talked about with the rating agencies, where they're like, oh, in the past, the worst we've seen AAA highly rated bonds fall is 5%. And so let's assume that the worst that can happen is like 3 times that, 15%. The problem is that some of these assets ended up becoming worthless, and so lost 100% of their value. So, it's almost like past performance is not indicative of future performance. Like if you base your model off of historical events, then something might come and bite you in the behind there. So that was one thing and that's the other thing. A lot of these assets were newly created. No one knew what a CDO squared was. You didn't even have data on that. The other thing, though, that was probably more disconcerting, and this is something to think about in in this current crisis, is that correlations went to 1. And let me explain that in layperson's term. I call it the ziggy-zaggy theory, right? What is the ziggy-zaggy theory? Is that, when Amazon zigs, what happens to Facebook? It probably zigs too. When Amazon zigs, what happens to a coal company? It doesn't care, really. Or maybe it zags. And you can do this ziggy-zaggy across everything. What happens to stocks versus bonds? What happens to bonds versus mortgages? What happens to mortgages versus trading gold and so on? And basically what you're doing, what the ziggy-zagginess is the correlation, right? And so two assets that are very highly correlated would be, FANG. When Facebook goes up, Apple probably goes up. And when Facebook goes down, assets probably goes down. But then again, if you look at, Facebook relative to a coal company, the correlation might be 0, meaning they don't impact one another. Or the thing you're always looking for is something that has a negative correlation. And there's very few things that have negative correlations. Sometimes some types of commodities do, from time to time, gold does. But what was happening is that the correlations of everything went to 1 because everyone was selling everything. And you're actually seeing a little bit of that today. We're recording on Wednesday, April 9th, where in the midst of the Trump tariffs, the stock market's down 20%. And you would think that normally when the stock market is down, bond prices go up, but bond prices have also been going down. So the ziggy-zaggy is broken. And so if you look at your model, it's all fucked because that's not what's supposed to happen. And with something like stocks and bonds, you have 80, 100 years of data on this. And so people can become over-reliant. And that's a really important lesson in a crisis is that correlations go to 1, right? People just want cash, right? So let's talk about what's happening here. So we have the market tanking. You have all these banks going under. You have these iconic US firms being absorbed by one another. You have every single correlations going to 1. Every single asset price, every single asset's going down. And guess what's going down a lot? The housing market, especially the subprime housing market. People are walking left and right on these homes. And remember, because these homes have been packaged and repackaged, they are everywhere. Remember, too, that I use that 80% example where people are like, this will never lose money. These things that people thought would never lose money, AAA bonds, were losing 100% of their value. And that leads to a huge, huge problem. Now, what is that problem? Is that these AAA bonds are being bought by, like I said, let's call them Main Street types of organization. And this is where this stops being a Wall Street problem and becomes a Main Street problem. And I want to talk about 2 ways. This is effectively a massive liquidity crisis where the dollar you thought was worth $1 is not worth $1. And remember, these are the dollars that are used to pay employees and pay suppliers, not the speculative dollar that you think is going to pay off in 10 years, right? And so one of the big examples of this was a mutual fund by the Reserve. I think it was called the Reserve, at risk of breaking the buck. So what does that mean? When you have a mutual fund, like imagine your mutual fund, you get like a little bit extra, a couple basis points, 10 basis points more interest than your traditional savings account. And that's because they take more risk. This money market fund is actually a mutual fund, and they go out and they look for, guess what? AAA assets, right? And so you could buy a AAA Microsoft bond, you could buy a AAA bond from your utility, you could buy US Treasuries, and you could buy AAA subprime bonds, you could buy AAA CDO bonds. And so some of the more aggressive money market funds were exposed to these dicey subprime bonds that were losing 80 to 100% of their value. This is a huge problem for the banking system, because you don't buy a money market fund ever thinking that you're going to lose principal. You buy a money market fund saying that I give you $1, maybe I need to park cash for a down payment or emergency cash for a couple of weeks, couple months, and I better goddamn get my $1 back when I want it immediately. Guess what? Not only could you not get your $1 back, there was a chance that you weren't going to get your $1 back. And this was a huge problem for individuals. Again, this is where it went from, one of the ways it went from becoming a Wall Street problem to a Main Street problem. This also happened at the corporate level, where it's not money market funds, but there is an equivalent, and I'm being a little rough around the edges here, but it's called the commercial paper market, where again, banks, companies like Microsoft, they just like you and I need to hold cash for bills and rent and emergency fund. Well, Microsoft has to do that too. It's just like $5 billion, where it's a couple $1,000s for us. So they invest in what's called the they park that cash in their version of the money market fund, which is called asset-backed commercial paper, ABCP. And guess what? People were getting dinged there too. So again, it starts to become it really becomes a Main Street problem, and then it becomes a run on the bank problem. One of the more notable issues that you saw was there was a risk of bank runs, because remember, if you deposit money at Citibank, they have more loans, they have lent money out more, or they have spent money more than they have deposits. So they can't pay everyone back at the same time. They can pay, if 10% of the people want their money back, they can pay them back. But if everyone wants their money back, you have a bank run, and then the system collapses. That's why the FDIC has an insurance policy which says the government will step in. And I think at the time it was $100,000. And they basically raised the limit to $250,000 to prevent this bank run, which was crazy. And that's a very expensive insurance policy for the US government. And I remember people, even like myself, I had more than $250,000 cash. So I was putting $250,000 in one institution, $250,000 in another institution. So this is how the bank runs were happening, because of the breaking of the buck, because of the bad assets that they own. And so you can see the interconnectivity of the entire system. A few stories that I wanted to share there. And there were layoffs across the board. So I don't know if we're at the end of 2008 at this point. I think stocks are down. The peak to trough was 46% for the S&P. At this point, I think the trough was sometime in 2009. So, it continued to be complicated after Bear Stearns went under. So that was the collapse. And so a few stories here. People were losing their jobs. People at banks were losing their jobs. The economic uncertainty, people were losing their jobs. Anyone related to the housing market, realtors, appraisers, they were losing their jobs. It was job losses across the board. So again, this is where Main Street and Wall Street are interconnected. It's an interesting observation for what's happening with the Trump tariffs, is that Main Street and on Wall Street are also, someone said it's just rich people losing money in the stock market. It's when the stock market goes down, companies lay off people. When companies lay off people, people stop buying stuff. When people stop buying stuff, companies stop making stuff. When companies stop making stuff, companies lay off more people, right? And so it is this kind of virtuous cycle of what you could call vicious cycle of what you call the wealth effect. This was some interesting data points here. In 2007, I bought an apartment for 700,000, new construction, and I put 10% down. And I think I had a 3.5% interest only mortgage. And a friend of mine basically bought similar apartment, different neighborhood. When this is happening, that friend, so you can see the real consequences. So your stock portfolio is down. You're scared you're going to lose your job. You're watching people, your friends are losing their jobs. Your bosses are losing your job. You don't know when the market's going to turn around. A lot of people were actually walking. It's a crazy thought in this housing market, but they had put 10% down and they were walking on that 10% because they're like, I'm underwater. This condo I bought is down more than 10%. I'm just keep my 10%. I'm just going to write that off as a bad decision I made. I don't want to be locked in to be forced to buy a house at a price that is significantly lower and then have to service this mortgage. Even though now we look at this 3% mortgage, we're like, whoa, what the fuck were we thinking, right? So this was happening with Wall Street people who were either risk averse or scared of losing their jobs or had lost their jobs. High earners were walking on the down payments that they had made to buy their house. I ended up closing on mine. I wasn't scared of losing my job because I'm not going to gloat, but I was a very high performer. So I just knew that they needed me too much. But I didn't walk on mine. And eventually it recouped its value, but it didn't do great. So that was what was happening. And so across the economy, you were seeing this vicious cycle of job losses, market uncertainty, and so on. Another thing that I want to share for the Zoomers and the young Gen X is that, this market's down 20. The market is down 46%. And 20 is a lot, but 46 is a lot. And when I tell you this, I want you to know that it really tests your conviction. And I saw a lot of peers, I've said this in other videos, that were committed to the buy and hold strategy, and they were smart, and some of them were at risk of losing their jobs. Some of them had lost their jobs. Most of them didn't lose their jobs, but they're like, I'm out. I cannot handle down 45%. It is stomach churning. I remember in 2008, 9, I looked at my portfolio, and I had been investing for about 9 years at that point. And I probably had like 400K in the market, maybe 300K in principal invested. And over that 9-year period at the trough, I didn't know it was the trough. I was down like 3%. So I had lost 3% on all of the money I had invested over a 9-year period. That's enough to make someone tap out. And what happened with those people that tapped out in 2009 is that they got this is the challenge with selling at the lows. Is that you have to be right twice, right? You have to sell at the right time, and then you have to buy at the right time. And what I saw with those peers, I see it's 2024, it's 25, it's 16 years later. A lot of them have never fully re-entered the market because they were shell shocked. And every time like, oh, well, Trump's going to be president, or, oh, COVID, or, pick whatever crisis was happening in that moment. And the stock market, if you cut out this down 20, was I think it's 4x from I think it was 10x from the bottom. Check that math for me. But I think it was 10x from the 2009 bottom to the peak before this Trump tariff claim. So then what happens? The government starts to step in. They start buying some of these assets, which eventually led to a lot of people being really pissed at the Obama administration for doing that. Excuse me. And then they changed the guarantees. They bailed out AIG. They bailed out the car. The car companies had a lot of problems with this commercial paper and also just declining demand for cars. So they bailed out the car companies, and that kind of turned a lot of the sentiment against government for bailing out these companies. Yet at the same time, you saw what happened when if they had not let Lehman Brothers fail, then it would have it could have been a different story. And again, I'm not saying you should bail out. These were all very naughty firms. So that kind of covers the story of the financial crises. A few things that I want to point out, like what's different. And so, or I guess, what are the lessons learned? First, the lessons learned are if you take a shitty asset and you try to repackage it, it's still a shitty asset, right? That's one thing. The second thing is that complexity, especially through structured products, really obfuscates the true risk or the hidden risk of the system. The third thing is correlations go to one in a crisis. And I think that's the thing, basically diversification doesn't work. The only thing that works is cash. The fourth thing would be, the amount of synthetic securities, credit default swaps can really take down a system. And then the fifth is that liquidity crisis and bank runs happen very fast. And once that genie's out of the bottle, it's hard to put it back in. And so how do I tie that into what's happening today? First, this is not investing advice. I don't know. I think that this is a very different crisis that's happening. To my knowledge, and I'm a bit removed from the market, there's a lot less leverage in the system so the chance of bank runs feels less likely, but you never know, right? We didn't think First Republic was going to be an issue a couple of years ago. This seems to be, interest rates are higher now, and you have inflation as a headwind, which is very different, right? It seems to limit some of the tools that you have. No one knows how the tariff regime will play out, whether it's a negotiating tactic, which with every passing day it doesn't seem to be, whether this is a genuine plan to bring manufacturing back to America. And that will take a long time to play out. One thing is for sure is that markets hate uncertainty. Even, if it's going to be bad, just tell me it's bad. Don't change your mind often. Markets hate incompetence that comes with that. And so from your perspective, what do? It's like, you go touch grass, you go remember that you are blessed to be watching this podcast and breathing the air that you're breathing and having the friends and family that care about you. You focus on your cash flow, right? Can you cover your expenses? Is your emergency fund big enough? You think about the horizon, right? I think a lot of people have shared with me that, they were 2 years from buying a home, 1 year from buying a home, 1 year from a renovation, 2 years from retiring. I'm like, why the fuck were you invested in stocks? Like, forget Trump, tariffs, Obama, whatever. If you're 1 year away from needing the cash, you should not be in stocks. My rule of thumb is 7, right? If you need the money in 7 years, don't buy stocks. And so think about the true horizon that you have with your portfolios. And remember, money is money, but it's one dimension of life. And we all live very rich lives, of which money plays a role, but not the only role. Thanks.